Hello, everyone. Good afternoon, good morning from where you're watching, and welcome to another webinar at Alpha Ship Academy. Thank you for joining us. Well, as you know, today we are diving into a very interesting topic for the maritime sector, which is the voluntary carbon markets. Especially, we are learning how this presents a unique opportunity for maritime organizations to go a bit beyond compliance. How, by integrating voluntary carbon markets into the decarbonization strategies, companies can not only meet the regulatory requirements, but also this can unlock new revenue streams, turning these sustainability efforts into tangible business value. And for covering this topic, we are very pleased to have today with us Marius Suteu, an expert in maritime technology and ocean sustainability innovation. He is managing director at Safety Tech Accelerator from Lloyd's Group, where he leads initiatives that bring advanced digital solutions into maritime operations to improve safety and performance. And he also served as CTO at ICNGO, using technology to tackle plastic ocean pollution in a global scale, among many other projects. So please join me to welcome Marius to the session.
Hi, and thank you for welcoming, and thank you for the opportunity to present this topic today.
You're more than welcome, Mario. I will let you with the audience today. I'll be managing the chat. If anyone wants to post a question, the chat is available, and we'll address that at the very end of the webinar.
Yeah, perfect. Thank you, Christina. All right, so let's dive into this topic. I think what I wanted to present here is a combination of strategies. So we all know that carbon markets are complex and difficult to deal with. And so what I was expecting to cover today is at least give you maybe not a guideline per se, but something that you can use in your day life. At least if I can get to provoke some different thinking in you, that will be more than enough for me for this session. So I cannot talk about carbon markets without really explaining kind of the impact of shipping that is having, what the carbon footprint of shipping in the global scheme of things. So probably you've seen this endless times, but shipping contributes to roughly about 2.5% of the global CO2 that is being emitted to the atmosphere by the human. Which basically means it's a 1.4 billion tons of CO2 output. That is quite a significant amount. And of course, it is something that we need to be careful with, but also we need to be smart about how we're managing that. So as probably most of you know, there are several different regulations because obviously regulatory bodies and policymakers have taken different approaches. One of the most fundamentally radical now at the moment is the EU ambition, which is called the Fit for 55, which is cutting the emission by 55% by 2030. So I think those are kind of just to give you a little bit the situation where we're standing at. It started quite as a nice way of presenting things, but at the end of the day, what's happening, and this is from a recent study that was published by ICCT in April this year, what turns out to be actually not maybe going in the right direction, like you will say. So what we're looking at is an increase of roughly about 12% of greenhouse gas emissions from global shipping. That is not necessarily created by the shipping companies themselves. So let me explain that. So while we have invested money in potentially increasing the reduction of carbon through the ships, be it more efficient ships, be it different fuels or whatever, there is another phenomenon that we haven't really looked at, and that is really causing us to have these, the gaps actually widening. So as you see here on the chart, what you're seeing it basically on that blue line is sort of the ambitions for how we should be slowly and gradually decreasing our carbon footprint. Whereas basically we take that measure of the 12%. This is obviously a projection, right? The orange line, but that projection shows that it actually goes in the wrong direction. So that compliance gap is widening, it's not shrinking. So what is really happening? Like, why is happening this? I think one of the main reasons has to do with the fact that we are buying more. We as a society, we're spending more money and we're buying more things. We are growing, and so the problem that we're seeing here is the fact that this is what I call that the demand is outpacing our ability to reduce emissions. So because we have to move more cargo, because we have this increased demand, even if we do our best at lowering the impact of shipping in that trade, it's still going to be a heavier impact because our technologies and the things that we are doing right now isn't enough. We could do a lot more. On the other side of the coin, although we have more people buying, we also this is a survey that was run not long ago. Consumers are willing to pay more, especially in more developed countries. They are willing to pay a premium for more sustainable shipping. So that's been seen, and that's basically the results. Roughly 74% of the people that were interviewed in this interview said, yes, we will be willing to pay a little premium if you can guarantee me that the shipment of these goods is more sustainable, therefore has less CO2 footprint. So it sounds a little bit contradicting, but at the same time, this creates a lot more pressure on the shipping industry in itself, because while people want to buy more and they will continue to buy more, at the same time, they want us to do it more sustainable. So we have a dual kind of situation where we have pressure from regulators. We have also pressure from the markets, as in the consumers demanding more strategic kind of sustainable shipping. So I think that kind of introduces a little bit the concept, because we literally fight in between compliance versus the strategic advantage that the carbon footprint and the whole carbon market brings to us. So this situation brings a slightly different way of looking at things, right? And so I like to say this quite a lot, is you might not be interested in politics. Oh, sorry, I mean regulation, but regulation is very interested in you. So let me explain that. In the EU alone, they have started already back in, this is already been going for a few years. And this year was the first one where they officially kind of started taking more seriously this implementation of the EU ETS. I call this a pay-to-pollute mechanism. So basically, you are, emitting. You have emissions from your ships and the industry. This obviously has been recently introduced for shipping, but has been ongoing for quite a bit of time for the wider EU energy sectors. And so what happens here is that's why I call it, it's a permission, it's a pay to pollute. You know how much emission you've got, you have to basically certify that, and then you have to pay a penalty, which is equal to what they call an allowance. For every allowance is a ton of CO2 emitted, and that price sort of varies a little bit, so it changes throughout the year, but it's more or less around roughly on average 78 euros a ton. So then you can calculate your emissions, and therefore you can calculate your penalties based on that. The idea and the concept of that EU ETS was what was the idea that they wanted to create some kind of financial incentive for change. So they thought, okay, if there is a penalty to be paid, therefore people are going to be more cautious and they're going to try to minimize their impact because that actually costs them money. Well, it's all right, and that was one of the initial hypotheses. It was meant to be a catalyst for greener investment, because you might say, well, if you keep paying penalties, you're literally wasting the money, whereas you could be investing money in greener technologies or transition, low carbon fuels or zero carbon fuels overall. So that kind of strategy was the initial thinking. And then also it kind of aligns as well, obviously, with the larger amounts of things that the EU wanted to do. So this is just to give you the context of why that exists, but I think it was an interesting way to bring it. Now, as you probably all know, this kind of pairs with the newest FuelEU maritime regulation, which still is still a EU-driven regulation, but it has a completely different mechanism. This is more like change your fuel type regulation, because it incentivizes and penalizes the emission pathway. So it creates basically the full end-to-end, or as they call it, the whale to wake certification of the emissions. So it has in consideration things like even the equivalent carbon generated from the production all the way to the time that it's actually been burnt in the engine. So it has quite an aggressive scheme. I'm pretty sure most of you have seen it and you've heard of it. And there is a great opportunity ahead of us in supporting us to transition to greener fuels, or more, let's say, harmful fuels in the future. So this FuelEU is trying to guide our decarbonization altogether. So it's trying to help us understand how the combination of the better fuel will eventually drive more technology or better technology, and therefore that will be kind of that loop of progressive greenhouse gas limits with robust monitoring and reporting, enforcement, and incentives. So it kind of outlines the idea overall of what the EU wants. I think it's important to mention this subject as well, because within the FuelEU, there are multiple different mechanisms that you can go about. And as I said at the beginning, it is about creating some consciousness of people knowing that there are different options available. So within FuelEU, there is a mechanism called pooling, where basically you can trade surplus. So either you have positive or negative surplus, you can then trade that. So if you have positive surplus, you can put it in platforms that there are currently available, where you can basically trade with that surplus by pooling with other people, because pooling isn't just about limited to your own fleet. It can allow you to partner up with other companies. It doesn't necessarily need to be within the same group. So by pooling, you then therefore reduce the impact of that pool of vessels, or you can use that mechanism of, like I said, the trading platforms to allow you to put that surplus so that you can then turn it more of like an investment, right? So you can turn that into a positive element that will help you capitalize on that surplus. On the other side, if you have a negative surplus, then obviously you can then go in the same platform and try to make sure that you can get probably a better deal than actually paying the huge penalties that you will have to pay otherwise. So this is just a one-off smart way of basically dealing with perhaps with FuelEU in the near-term future. And I think overall it's about trying to have an idea of what is your financial kind of strategy going forward, like short-term, mid-term, long-term, and how you can go about all of that, combining a lot of different elements that I'm hopefully going to bring over to you in this presentation. So the way they blend the FuelEU and the ETS is, I like to say that the ETS is more like the push, and then FuelEU is more like the pull. So it's that push-pull effect where you're trying to push people to reduce their carbons by financial incentives, in this case penalties, that creates basically, if you only kept that, it will create a business as usual operation, because then people will just adopt that penalty within their P&Ls and will just deal with it. With the FuelEU, you also then pull in the market into actually getting that, to taking that next step in the right direction. So this wasn't just about obviously fuel EU and the EU ETS and all that. But well, now it's been postponed, but as probably some of you knew, there was this IMO net zero framework that has been discussed and have just recently been postponed. And the reason, this is partly also why I mentioned that politics is part of regulation in this case, unfortunately. And that has to do with the fact that obviously some of the countries are withdrawing, or basically they were gonna vote against it. So the decision has been to postpone it by 1 year. What that means is, in reality, is that it's not necessarily a bad thing or a good thing. It just kind of, the way I like to see things is, it just creates another opportunity for somebody. So the postponement of that IMO net zero framework, it basically would potentially mean more regional mandates. So stronger push on things like fuel EU, ETS, and so forth, like we've seen in the EU, might be adopted also in other regions. We know and we've heard that Japan and some other countries are starting to consider things this way, because in fact that's one of the ways that this is potentially going to end up, right? So that will create a little bit of attention. And then also on the other hand, you are left with what I call this market hype, that now people are going to start looking at, okay, what do I do? I've got to do something now short term. So what is my best way of approaching it? So people are going to start looking at voluntary carbon markets. People are going to start looking at things like insetting versus offsetting, which I'm going to explain now in a bit. So hopefully with that, like I said, it's not necessarily a bad thing or a good thing. It creates a different set of opportunities that we should be aware of. And I think this is a smart move if we start thinking about the holistic approach. So what I see right now, given the critical gaps that we have in the regulation, is that you have a time issue, the time gap, and you have a leadership gap. And why is that? Is because, well, first of all, you have a time gap because basically all alternative fuels and new technologies, everything that is so promising and in fact is gonna actually give us let's say the results that we're expecting. It's just that it's not gonna happen in the next year or 2 or 5. It might happen in the next 10, 15 or 20 years from now. That is something that we've got to think about, and that is something that we need to factor in when we're making decisions going forward. The other thing is that leadership gap that I'm talking about is because this regulatory compliance issue, it only prevents you from being left behind, so being a laggard, but it doesn't really position you as a leader. So what can you do if you're in a company and you want to make let's say a stronger statement around your carbon management? Loads of the big companies have made big claims around their net zero frameworks and ambitions. So how they aiming to achieve that over the shorter period of time than the initial ambition was setting. And that obviously is not going to come by just flipping a switch and be there. So I think those two questions are quite important for us to keep in mind if we are trying to do something in the space. Is the question number one is, what do we do about emissions today while we wait for tomorrow's solutions? Because that's effectively one of the problems that we're facing right now. The other question is how we can demonstrate market leadership and capture competitive advantage. So is that even possible? You might wonder. So I think it is, and I think it's partly has to do with combining the ambitions of the different players. So it's about collaboration, of course. Collaboration is going to be key, but it's also around understanding how you can effectively manage the needs and the challenges of owners and charterers, and then come up with something that can be a good combination for both. So here's what I like to introduce this term. Probably some of you know it, probably some of you don't, but I like to introduce the term of insetting, which is different to offsetting, which I'll explain now in a bit. But it's insetting in effect is basically it represents kind of the gold standard for the decarbonization. And that is basically the approach. It's an investment. It's a long-term investment that you're making to effectively reduce all of your actual emissions at the source. So this is effectively a set of things that you are going to be investing in as a company, so that it's going to help you reduce dramatically and effectively all of those emissions in the future. So that could be things like, for example, alternative fuels, wind assistant technology, hull optimization. Here we have a bit better understanding of this, because this investment that is mostly right now focused on basically alternative fuels, ship performance, which includes everything that has to do with hull and propeller and engines, and all of those improvements that we carry out, as well as wind assisted, and also route optimization, which is a tinier portion but still relevant. So this is how currently right now the industry is combining different strategies. So investing in these things is not going to be something for today, as we say. Well, perhaps route optimization and some of the other ones might be as well impacted somehow in the shorter term or midterm. But effectively, you're going to gain the results of these investments throughout the longer period of time. So that will allow you to kind of future-proof a little bit your vessels. Now, obviously, there is always a discussion around which one is best. And I'm not really going to get into which one is best or worst, because it has to do quite a lot substantially, I would say, with your area of operation and your operating profile. So it depends on multiple factors. You might be more eligible to one technology or one solution, one strategy. There is no one single strategy that fits all in this case. Now, let's move over to offsetting. And offsetting has to do, in this case, mostly with the voluntary carbon markets. Now, I want to be very clear with this, because I think there has been, or there is still in the market, a little bit of uncertainty and clarity around this topic. And I think the voluntary carbon markets, they offer us a great opportunity if you know how to manage them well. So let's look at it a bit from a different perspective as to what opportunities it provides us, because it can provide us with, for example, proactive emission reduction. So these voluntary carbon markets can enable companies to invest in projects that remove or dramatically reduce the greenhouse gas emissions in other areas. So it can be seen also as strategic investment. So it can help you in, especially if you know how to manage let's say, how to work with the markets. It can allow to also enable more investment in innovative programs and technologies, and it can help actually get more traction in that area, right? And then also, and this is probably a little bit more intangible, but in many cases, to many companies, it has helped them dramatically into basically positioning themselves as a more thought leader or like a leader in sustainability. I know we are looking at sustainability as something about being green, but sustainability is a metric of success. And if you do it right, it is quite a powerful tool, both financially and operationally, for driving your company in the future. Sustainability isn't just about being green. It's also about being able to have a sustainable operation, to be able to have a sustainable P&L. So you see, it has to do a lot with everything else. Let's look a little bit at the different types of carbon credits that currently exist. I try to group them in these three categories, which is avoidance and reduction. These credits mostly are targeted for projects where we are trying to either reduce that or avoid it through, like, for example, projects like reforestation, industrial efficiency upgrades, like changing, for example, big infrastructure that will allow us to reduce all of that, system that will help us capture, all of these kind of projects are falling in this category. The other category will be carbon removal. So how are we doing, like, for example, sequestration? Can we remove carbon dioxide from the atmosphere elsewhere? Like, reforestation projects and everything that had to do with that kind of space. And then we have these nature-based solutions, which is basically a broad category of different projects that will help us restore or manage natural ecosystems. And as a consequence of that, therefore, it will help us improve kind of the CO2 absorption of the CO2 emissions. Again, this is an offsetting strategy, and these are kind of some of the types of carbon credits that you can find. There are going to be probably hundreds or thousands of them otherwise. What really matters is that you need to be able to verify this. So I think there has been instances where people have gone into the voluntary carbon markets, and they've gone probably they moved away from it because they got scared, or they got into sometimes questionable areas that people didn't feel it was right. And I think it has to do with the fact that we need to build up a framework that we can trust. So it's about making sure that, for example, we are not reselling the same credit 3 or 4 times. So there has to be some visibility around that. It's about having an independent verifier. So currently there are companies like Vera, for example, which are certifying quite a lot of the projects to guarantee that there is a consistency and there is a verification of these projects. And lastly, but not least important, is about having that transparency and traceability. So if you have these 3 elements, you are more likely to be looking at an interesting opportunity for you to tackle on this voluntary carbon market. It's substantially different than just not having any of these 3, right? So it's quite important. So if we're looking a little bit at the pricing mechanisms that they often use, is basically about what drives the value. And the fact that there is a pyramid here, it doesn't necessarily need to mean always that is, the top is the highest or the most expensive or whatever. It was just a more graphical way to represent the fact that currently today, there are like at the bottom, there are more like the market dynamics. So this is what broadly makes the biggest portion of the price when it comes to the value of these credits. So things like supply and demand, obviously regulatory changes, and the investor preferences, that plays a significant role in determining whether a credit costs more or less. But then obviously, that middle layer has to do with what is really this project delivering? Is there additional social or environmental benefit? Like, does it bring any benefits to biodiversity conservation or community empowerment, for example? If that's the case, then obviously that has more value, and therefore, price it could go a little higher. And lastly, at the tip, and again, not the least important or whatsoever, but it's also one way where you're looking at the type and the quality. So credits that are coming from projects that have, let's say, higher environmental integrity, that can be proven, that is well thought through, that is well documented, generally has obviously a higher price, because that has to be also something that they pay for. So they're going to pay for certification, they're going to pay for a bunch of other things. And that obviously is going to have to drive the price up. But ultimately, like I was trying to illustrate here, is you need to be able to evaluate these elements to understand whether it is a good option for you or not. If you have these tools available, you are more likely to make a good decision around one credit or another, or when you're evaluating that, this can be also serving as a good framework for you to evaluate. So let's look a little bit about some of the challenges that we often find when we're doing offsetting mechanisms like this. So again, while it still remains to be a very powerful tool, it is not without a bit of a complication sometimes to navigate. So most importantly, as we were saying before, it's about measuring the true impact. It has to be accurate, it has to be quantifiable, and it has to be like it shows a benefit to the environment, so that the offset can be called a real offset. The other thing that is quite important and is quite a big dramatic element that I have now gonna dig a little deeper into it is the risk of greenwashing. Because if we fail to do like proper standards and proper measurements, transparency, all of the things that we've talked about, if we fail to do this, we're gonna fall in the trap of greenwashing, and that's a big deal. Depending where you are in the world, you may or may not be affected as much by this. But if you are in Europe, there is also quite a strict regulation in Europe about greenwashing, which you might want to be careful about. Not just that if you're in Europe, but I think it's unethical for businesses to claim that they are impacting or helping in areas where they potentially are not. We all have our own common sense, and we all know sometimes some of the projects are a little bit doubtful. So if it's doubtful, then just don't jump on it. And the other thing that we're seeing quite a lot is the fact that many companies, especially the bigger ones, they haven't stopped speaking and advertising about sustainability and their programs and what they do, but they're just doing it a bit more quietly, in the sense that they're not gonna stop the investment. They continue investing quite a lot, but they using that less as a marketing strategy and more as a real impact that they want to have in the environment and so forth. So I think that says quite a lot. And lastly, but not least important, is this leakage. So if we ensure that the emission reduction are genuine and permanent, then fine. If we cannot ensure that, then obviously there's going to be a bit of a concern here, especially for those projects that are related with nature-based solutions. So if we can address these three concerns when we are doing, when we're setting up our offsetting strategy, then it will be a lot better. So let's talk a little bit about greenwashing, as I was announcing earlier. So what we're doing with greenwashing is this big word that means a lot, and most people are afraid of. So let's look a little bit and break it down. I try to break it down here in 4 key pillars. So the idea behind this is that you want to avoid greenwashing at all means. And you want to avoid it is because you are an ethical business and you want to do what's right. And you're looking at the voluntary carbon markets because you see the opportunity, not just because you want to get yourself a medal saying that you are contributing to this and this project, and you want to feature that in your website. Is actually because you want to have the real impact. So the first pillar for me when it comes to greenwashing avoidance is scrutinize credit quality. Check, double check, ask for any feedback and paperwork, standards, anything that might be available, methodologies. Most of the companies that are dealing with in the voluntary carbon market, if they're trustworthy and they know what they're doing, they will be having no doubts and no problem in providing you this information. So always double check and triple check. If you have any doubts, you can always ask the company to provide you with more evidence or more support, and that's going to be in your benefit. Prevent double counting. There have been instances where we've seen potentially situations where people have claimed a credit, and then that credit through the company that was selling it or the platform or wherever, it was not retired. It still remained out there in the public. So it actually has happened where you've had this double counting effect. In theory, one can claim that it's not actually your fault if you've been subject to one of these incidents. It could also be that, again, it wasn't your fault. It was the other company, other platform that didn't do something properly, or maybe it was just an error of the system or whatever. It doesn't matter. But at the end of the day, you can default to pillar 1. So again, you can scrutinize and check and triple check all of this information before, so you make sure. So the pillar number 3 is about ensuring additionality. And that means that basically you want to verify that the project will not have occurred without carbon finance. So it's about meaningful investment. So for example, if you take a project that claims that it's going to reduce carbon in, I don't know, by planting a tree in an industrial area or a port or something like that, that definitely is not gonna really solve a problem, right? So it's probably not the best example, but it's very clear that the most important thing here is about ensuring that additionality happens. Like without that money, it would have not been possible to carry out that project, and that is genuine. And the fourth pillar, and I briefly mentioned about marketing and communication strategy before. It is about communicate with integrity. So be transparent about what you're using, what you're doing, and how you're leveraging these carbon credits. There's no problem with that, but also avoid absolute claims and clearly distinguish between reduction and offset. It is not the same. So you just got to do what's most ethical and is right. If you're uncertain about how to communicate, obviously there are lots of different people that can help you with that. But most importantly, is don't make claims that you cannot sustain. I think that's a summary of that pillar. So with this framework, those four pillars that you have, you can have a more, let's say, an easier, perhaps, appetite. No, maybe not easier, but you can have more appetite for looking a little bit at these voluntary carbon markets. They have been around for quite some time, and there is no doubt that they are going to continue creating opportunities in the future. All we have is, just like everything else that we look at as an investment, is to be careful and know how we can manage that together. So let's start wrapping this up a little bit to give you some hints as to where this can actually lead overall. So we talked a little bit about the impact of carbon. We talked a little bit about the regulation, how it's supporting, how it's forcing some of the players to making decisions. We talked a little bit about insetting and offsetting. And now I think it's about kind of starting to draft a little bit what a strategy might look like if you were to combine the two of them. So if we're looking at the graph here on the right, what you're going to see is the offsetting strategy. It can help you reducing your emission footprint from the very, very top end. Let's say over the years, it can get you to reduce probably about, let's say, 15 to 20%, depending on the project you might be involved and whatnot. But if you look at the green line that climbs up, that effectively is your insetting strategy. So the idea that you have regulation on one end, you have opportunities for investment longer term, that's your insetting, and opportunities for investment in the shorter term, that's your offsetting. That combination of things, it can help you create a very strong, powerful kind of short, mid, long-term strategy. And it's not just about what you do today, it's about what you're going to do in 10 years from now, and what you can do in 30 years from now. Because especially when we're talking about ships, these are assets that will last us for at least 25 to 30 to 35 years. So we've got to think with a mentality that it's not all about the technology that goes on a ship. It's not all about the fine and the penalties that I pay now, this year or next year or whatever. It is about a combination of things and how I can put that in perspective holistically to come up with a better solution. I have dared to do this kind of 4-step action plan just to, in case it might help anybody in creating a sort of a outline of an idea or a strategy. But obviously the step number one is identify. So we need to conduct a comprehensive footprint analysis across our entire operation. We need to be able to map the reduction opportunities through insetting potential, and also currently unavoidable emissions through offsetting, for example. Obviously, you need to take in consideration everything else, like if you're trading in the EU and you have to be subject to EU ETS and fuel EU and so forth, that's also part of the game. But again, those are regulations that are incentivizing you, quotation mark, through penalties and penalizations. And that's the way that they're going to have to incentivize you. Therefore, these are more like opportunities for you to invest. So the step number one, obviously, is then going to be based on that operation profile and area of operation that you've clearly outlined in the first step. Is about how you want to more intelligently invest in that insetting strategy. So what sort of fuels, what sort of technologies, what sort of operational improvements are you going to be investing money in the next 5, 10, 15 years, so that you can be able to meet your targets. Step number 3 then is obviously compensate by offsetting. So as we were looking at the offsetting, especially the voluntary carbon market, but also other mechanisms, just remember to focus on verified projects. Make sure that you have all of the documentation, make sure you have all the integrity, especially the high integrity carbon removal credits. These are going to be a really good strategy for you to help in kind of minimizing that impact in the shorter term. And step number 4 is about verifying and communicate. So verifying let's say the results that you're getting through all the projects, how you're reducing. You want to make sure that you are providing that kind of continuity and that you are actually improving over time, that you're not getting stalled or you're actually going up, as we've seen at the beginning. There could be a number of different things that you need to vouch for and you need to account for, and that is effectively the fact that we're talking about demand, increase on demand, and we talk about all of these other elements. And it's also important to account for all of those things. So constantly monitoring and checking how we do, it is quite important. I think it's going to be in one of the key steps here. So let's say that we have now created something that is valuable. So you can choose effectively. This is an option that you have. You can choose between being more reactive. That's basically the compliance burden. So you're just going to do what regulation tells you to do. You're just going to try to, maybe pass on the charges of that. You might basically just look at reactively taking a decision here and there or whatever. That's an option. The other option is being more proactive. And I think throughout this presentation, I'm hoping to have given you at least tools and an opportunity to look at things more from a proactive approach point of view, because that's more strategic and that brings you advantages. Advantages like, for example, credible climate leadership. You can win probably more contracts, even financing in that case, because of your sustainability profile improving and so forth. And why not? But also we're talking a little bit about innovation and technology. Innovation in this matter actually is quite important, because through especially the insetting strategies, you can also be a first mover. So not only be seen as a sustainable kind of leader, but also as a first mover in technology, in this case, benefiting from perhaps opportunities that new technology will bring, that other will probably lag behind. So every person has a choice to make, and I'm hoping that through this kind of presentation, we helping clarify some of the doubts that might have been around that topic. So altogether, when we're looking at it as a collective, let's say, holistic approach, combining the insetting, which will help us reduce, with the offsetting, which will help us compensate, we can gain probably more market leadership, and obviously we're going to be able to comply with regulation in a much better way, in my opinion. So this was all for today. I want to thank you all for your time, and yeah, I'm available for any questions if there are any.
Well, thank you very much, Marius, for your exposition. It was super interesting, I must admit. Now we have the chat open for any Q&A for the attendees that might ask Marius any question or pose any concern about the topic. And meanwhile, myself, I want to ask you about who would be stakeholders for this kind of strategies? Meaning that if a company, let's say, wants to start approaching this kind of strategies, what kind of companies or institutions may we look for helping, guiding, and participate with us in this kind of strategies?
Yeah, that's a good question. I think there are, first of all, there are trustworthy verifying entities like Vera, for example, which will help a lot into identifying whether a credit is good enough or not, whether it's got all the, let's say, the verification and the information required. That's on one end. The other thing is this is partly or largely, I would say, a financial instrument. So, I'm not sure to what extent banks, but certainly financial institutions and consulting firms will be quite useful in bringing you a bit of a better kind of overview of how you can leverage all of these strategies into your current company. So I think those two kind of will make quite an interesting, let's say, combination. So having somebody that can verify and give you trust around the credits that you're aiming to invest or whatever, and then also having somebody that can advise you from a financial point of view, what is the more plausible kind of strategy.
Thank you very much for your answer. We have here a question asking, what will be the best strategy for a project or organization to create these blue carbon credits?
Right. So if you want to create the carbon credits, as in you have a project that you want to create and you think you're going to have that positive impact, the very first step is to first of all do obviously the analysis of the business model. So understanding what is the real impact that you're going to have, understanding how you're going to be creating the credit mechanisms and so forth. You're going to need basically the support. I'm going to mention Vera again because it's a larger one. But you're going to need the support of an organization like Vera, in this case, for basically setting the foundation of all of the verification process and the methodologies and how you tracking, all the different KPIs that you want to hit. And then you're going to probably need also, depending on the technology or depending on the project in itself, you're going to need some kind of advisor, technology advisor, or let's say advisor altogether for understanding how you can piece all of the different components together. So I think those two could be a starting point. And then of course you're going to need, once you have that all set up, you're going to need to be able to work with the different vendors or platforms so that you can put that credit towards the market. It could be financial institutions. There are other platforms that are starting to build up some let's say competencies, digital platforms that are building competencies in that. But I think those three elements are going to be important. So it's the verification services from somebody like Vera, advisory on technology or implementation of the project, and then third is the financial institution that can help you with creating the credit mechanisms and putting them through a platform.
Well, I hope that was a complete answer for our attendee. Thank you very much. Yeah, it sounds to be very helpful. I also want to introduce the topic of money because we haven't talked thoroughly on that. Could you provide an example of any kind of project in this, maybe in setting, which I think is the most interesting at the moment, although perhaps offsetting projects are more available, let's say. But how can this kind of strategies have a economical impact in the companies that pursue? It's just a matter of avoiding to pay penalties for the emission regulations, or can we expect something else from these strategies?
So that's a good question. So you have let's say, two main drivers. So you have regulation and the market. And the market, I mean the consumers that want to buy goods. And so, like I was explaining at the beginning, regulation is going to incentivize you by creating penalties. So these penalties are going to be there and you're going to continue to pay for them if you don't do or don't change something today. The other one is the market. So as you decide not to do something, so let's take an example of a company decides to do nothing at all, and they just carry on and they continue paying penalties. What's going to happen to that company is not only that they are going to continue to pay huge penalties to a point where it's going to be unsustainable, but also they're going to be outpaced in the market by other companies. Therefore, when they go and quote for a freight or something, they're going to be having to drop their prices substantially compared to others, because others might be offering the same service and might be better suited, as in greener shipping, lower carbon, etc., etc. So you're talking about money, you're talking about the combination of, one, you want to make that investment in technologies, like we said about, alternate fuels, other technologies in the ship, etc. And you're looking at it as an ROI component that will help you to decrease your penalties, but also help you be more competitive in the market, because you can then price yourself either higher or at least stay on par with competition, because otherwise you're going to be outpaced. I'm not sure if that makes sense and if I answered the question.
Yeah, I understand. But is any way, besides, I understand why you position that by pooling, if you have any extra carbon credits about that comes from investments in this reduction of your emissions or more efficiency in your pollution, you have, let's say, extra carbon credits you can put in the market. And can we trade this as a way of profit?
Yes. So pooling is a mechanism that is implemented through the FuelEU regulation in Europe, and that effectively that's exactly what is allowing you to do, is to first, if you are underperforming, meaning that your emissions are way higher than expected because of the methodology and the calculation. I'm not going to get into the technicalities of that, but you have an option to buy excess, let's say, from somebody else. So then by pulling into that, you're paying somebody money through these platforms. You're trading that. So instead of having to pay a penalty, which will equal, making up a number, but let's say you have to pay a penalty of 1 million, but if you pull, you probably pull in and you pay, I don't know, 300, 400,000 instead. So you're still going to pay money, but not as much money as if you were going to be penalized. On the other side, if you're a company that is doing quite well and you have invested money in technology and opportunities to reduce your emissions, you're going to have this surplus. Then you can sell it. So you can make money with it. That's the idea. So yes, you can certainly make money. And that's also why there is such an important thing about investing in technology, investing in, kind of reducing that footprint over a period of time, because it also helps you to capitalize on the benefit, on the excess that you have.
Okay, understood. And we just have five more minutes, but I would like to ask you if you can mention some examples that are currently operating in the industry that we can look at as leaders in this kind of in setting strategies. And if you could just a little bit go a bit deeper in the in setting, because I understand that offsetting is quite what we always saw in this kind of greener strategies and sustainability strategies, with compensating emissions and also reducing your emissions, having your carbon footprint measured and try to reduce as much as possible. But the in-setting, let's say, concept is quite not as seen. So if you could just mention a couple examples that can help us understand a little bit more better this kind of approach.
So I think in-setting is, in-setting, let's look at it from a more strategic point of view. So for example, if we take, I'm going to avoid quoting the name of a company, perhaps, but there is a company that just recently announced basically a similar strategy that I'm highlighting here. It's a combination of different things. And so what they're doing is, first of all, they have created a baseline of their operation. So they operate in, I think it was 50 vessels roughly, all around the world. And they said, okay, my carbon footprint for year one is 10, let's say, just a number to illustrate the idea. So then they started thinking, okay, what can I do to improve that profile now? So first of all, they started looking at how can they more effectively operate those vessels. That meant software solutions for route optimization and things like that. That meant also things like, for example, improving the crew change, so that they have more, let's say, options, and they are more clear around where these crew changes need to happen. They started investing money in things like, for example, HAL and proper technologies to improve the cavitation and to improve the energy efficiency of the vessel. So all of these, let's say, largely will probably represent a saving of about 10% overall. So the combination of multiple insetting strategies, like combination of all of these different things, it will probably get them a 10% reduction in the very short term. So that's already a gain. Like if you're looking at that comparing to somebody that is not doing anything about that, you're already 10% better. And so that's what insetting is about, is what are the things that you can do, but it's not that you do it once and then you forget, is what are you actively doing to reduce your carbon footprint. Not sure if that helps.
Okay, so would you say that it's not only about, because now the trends are all the time like around alternative fuels, um, new engines and all that, reducing emissions through zero emissions fuels, or about fuels. But I think we are lucky, maybe focus on technologies and optimization of the voyages and pollution through the main operational system. So would you consider that companies may have a better benefit from a strategy in a long term, investing in optimization, in technologies for optimization of the vessel's operations, rather than investing in the new fuels, in new construction of vessels that burn different kind of, let's say, more efficient or less pollution fuels in the short term?
Yes, in the short, yes. And let me use an analogy then. So think of it as again, investment. If it was your own personal investment and you were to put money on the stock market, for example, and then you saw this one stock that everybody's putting money into and everybody's talking about, and you're like, yeah, I want to put money into that. But first of all, you don't even know how much money you have. That's basically what's happening here. So companies are making investments in long-term strategies like alternative fuels, which again is very much needed, and we need to know what's the next wave of technologies that are going to come in 20 years from now. So we need to start investing today. But companies are making that investment without knowing what's happening today, and even without knowing their operational profile. So maybe you're investing in a fuel, ammonia, that might never be available in your region of operation of the vessel because of whatever, either aspect of either regulation or whatever it is, it doesn't matter. So why not invest in money first in the smaller pieces of technology that can help you today? Understand your operating profile, understanding how you can do better. Like I like to say a lot, you can manage what you can measure. So first start measuring what you are doing today, and then you can start improving it.
Yeah, I think that's a wise advice for our shipping companies. And we, unfortunately, we have run out of time. This is a very interesting discussion, of course, and I hope all the attendees did enjoy it. This webinar will be available at our site, and of course we will share some information regarding this topic with all the attendees. And thank you very much, Marius, for your intervention, your explanation, and for providing us with some insights about future strategies that companies are really needed to consider. And it's been a pleasure, really, and hope we can count on you in the future for more webinars like this.
Yeah, we're very happy to help. Thank you for having me, and yeah, thanks for all.
Well, we will close the webinar for now. Thank you very much, everyone. Let's get tuned for new new sites with AlphaSheep.